the week before, and so I was coming back. When I got back, it was playing catch up time. I didn't catch up till like late Tuesday. Let's see. Uh, all righty. Good morning. Happy Monday. Hope you all had a great weekend.
Right, we're getting
Hope you all having a great start to the year. We're pretty much already almost done with the first quarter, which is pretty wild. I feel like 2023 was literally a couple weeks ago. But Q1 is almost done, which means we're about to lead into Q2 where we believe that rates are gonna really start to come down a bit, not to the point of being in the fives. I think we're gonna be starting to come down gradually. Last week was the first week that we had where rates dipped down for the first time in a couple weeks. And I think we'll see that continuously moving forward, just because of where the Fed meetings where they're lined up and where we're seeing inflation. I know there's a lot of talk on whether the Fed is going to start to cut rates sooner rather than later. I don't believe it's in the next meeting, which is it it's either at the end of this month, the beginning of April. I think it's going to be starting around May or June is when they'll start cutting those rates. So around that time, mid Q2, I think we're going to start seeing everything kind of come down a little bit as we go towards the summer. So PCE, personal consumption expenditure, came in at 0.3% month over month in January, and it fell to 2.4% year over year from 2.6%. So core PCE, which strips out food and energy, lowered from 2.9% to 2.8%. So we're slowly getting to the finish line here. Little by little, we're getting close to that 2% mark the Fed wants to see. Remember, guys, that PCE is the real inflation number that the Fed wants at 2%. CPI, which is Consumer Price Index, and PPI, those are more so headline numbers. That's to kind of gauge the move in prices month over month, but PCE is what people are actually spending month over month and year over year. New home sales, which are contracts on new construction homes, went up 1.5% in January, and they were up 1.8% year over year. Median sales price for new construction homes is currently at 421,000. Pending home sales, which are contracts on existing homes, fell 4.9%, and they're actually down 8.8% year over year. Lawrence Yun, which is NAR's chief economist, said that consumers are showing extra sensitivity to changes in mortgage rates in the current cycle, which is a bit obvious since affordability is such a big thing right now. My assumption on the new homes is that incentives from builders are really driving down the buyers' rates into the fours. We're seeing that even as early as this past weekend. I had a client that went up to Orlando to look at some homes, and the new construction lenders are basically giving incentives to buy down the rate enough to get them in the low fives, high fours, which is extremely beneficial for clients. So every time I see that, I'm completely honest and I say, look, if you want that, go ahead and take it. There's some new construction lenders that don't really give credits. And that's where we'll be able to come in, or they disguise the credits with extra fees, extra junk fees, and we're able to sift that out. But if they're able to get you a low rate as a client and pay down the rate enough for you, where you just have to come in with down payment and closing costs, it might be worth it for you. Case-Shiller Home Price Index came in for December, showing appreciation of 5.5% year over year to end 2023. So remember, Case-Shiller is kind of like the gold standard when it comes to appreciation in the market. Month over month, Miami, Charlotte, and Chicago, all three tied for highest change at 0.6%. They were tied for third place. Second place was Los Angeles, which was at 0.7% month over month, and first place was Las Vegas, which came in at 0.8% month over month. The national average month over month was actually at 0.2%. So you'll see all five of those cities, the three that tied, Charlotte, Miami, Chicago, and then Los Angeles and Las Vegas, are well above the national average of home price appreciation. So us being in the South Florida market, and remember when they say Miami, they don't mean the city, they mean the Miami metro area. So they're talking about Dade, Broward, and Palm Beach County as well. So as we continue to see home prices come up, we know what that means when it comes to clients that are looking to sell, which that sentiment is also higher, by the way. A lot of people, a lot of sellers feel like it's the perfect market to start selling now. Probably right before the rates kind of come down. Maybe they should wait a little bit more, but you're starting to see more sentiment from sellers, according to Fannie Mae. The BLS jobs report came out showing revisions to the huge numbers we saw last month in December. So remember that February rates kind of increased because of that original jobs report that came out. Well, there was 167,000 jobs in those 2 months that were cut from the original reports. We also see that unemployment increased from 3.7% to 3.9% in February. But both average weekly earnings and average hourly earnings are up. I think the average hourly worker nationally is at like $34 an hour. And I think the weekly earning average is about 1,100, like I think it was like $1,138 a week or something like that. ADP's report, which is just for private sector jobs, show growth below what was expected. 140,000 new jobs as opposed to the 150,000 that was expected. Annual pay is also still increasing with people that stay at their jobs. So job stayers are at an average of 5.1% increase year over year. But people who leave and get a new job with more pay, they may be within the same industry, but those are basically people that change jobs. Those are up at 7.6% increase. So, I mean, that's always been historically, right? You're going to make more money when you leave your job and you go to a new one. And we've seen that, I think within our generation, I think the generation before us really like to stay at their jobs and finish it out forever. And we're seeing a lot of people after 2, 3, 4 years, they may feel like they hit a cap. They move over to another position at another job and start to get paid more. FHFA approved 2 new credit score models, FICO 10T and Vantage Score 4.0. So the difference with these credit score models, as opposed to the ones that are used now, is they track more trending data. So a lot of the credit models that are being used now, they are, and I want to say black and white because credit is very, very tricky, but they don't monitor things like how often does this person pay their credit card in a month, right? They only show that one time it's reported, right? Was this debt consolidated? Did they pay down their full balance and then increase it back up on something else, right? The actual trending data that somebody, a normal consumer would do day to day. So both of those track the trending data as well as what's on the credit report too. So that should actually help people show a higher credit score. And on the flip side, may hurt some people too, depending. There also has been a proposal to not have title insurance a requirement on refinance transactions. And this could cut borrower costs a lot when trying to refinance, because I'm thinking too, if you don't need your title, if you don't need to have lender's title insurance when you're doing a refinance and you already have your owner's title insurance, because your owner's title insurance protects you for the life of the time that you're an owner, do you need the title company to do any sort of title at all when you're refinancing, right? So that could save you money there, which surface level, it would make sense. But there's things that really aren't clear that maybe should be ironed out or will be ironed out. For instance, if I bought a home and I had title insurance when I bought, I should be fine when I refinance as well, right? Whether I want to lower my rate or do a cash out refinance, it makes sense. Why would I need title insurance again when nothing has changed within the property that I purchased? However, if I were to quit claim deed over to someone else, that was never a purchase, right? Essentially, it could have just been the title was just quit claim deed to that other person. And now after a set period of time, they're able to refinance. Does that mean that they also don't need to get title insurance? Would that put that person at risk or at liability because there is no title insurance that really protects them? Will they still have the option to get it? Or is it just because it's directly from the FHFA, it means that absolutely, if you're refinancing, that's out of the question. So just a couple things that I think that I had questions from the beginning. Would love the perspective from a title agent to kind of speak on this to see how it could affect title insurance premiums. That's another thing, right? Do premiums now go up on purchases because they're trying to make the money on the back end? As you know how this industry is, if you lose on one end, you're going to try to make up for it on the other end. It's just pretty typical to what we see here. So do title insurance premiums now start to increase? And now on purchases, those closing costs become much heftier as well. A lot of questions that should be answered to see how this could really help, right? Because you see the pro, but also hurt people because you see the con as well. Does anybody have any scenarios that they've gone through over the past couple of weeks? I did mention to everybody, I apologize for not being on last week. I was out on Charlotte the week before and I was just playing catch up for the most part Monday, Tuesday. But if you guys have any scenarios or any questions on any programs that you've seen come out that you have any questions on, we can kind of go over it now. If not, I'm going to talk about, where's my chat here? Okay. Couple housekeeping items. So first off, soft credit pulls are in for us, and we are able to do a soft pull and run DU at the same time. We got it approved directly with Fannie Mae, Freddie Mac, with the credit company that we use. So moving forward, the team is going to be trying to do only soft pulls with new clients that come in, and that's really just to couple reasons here. Okay, it's not only because a lot of clients think that hard pull really affects their credit hard. On the normal FICO, it does not. Maybe on the Credit Karma Vantage, because the way that they weigh things, it could. They may weigh inquiries much heavier, Credit Karma, than anything else does. Realistically speaking, it doesn't really alter your credit. A hard pull, as long as you're not consistently doing it over and over and over again throughout a specific time frame of a year. If you're doing credit inquiries here, or maybe 4 times a year, 5 times a year, even if they're for different industries, you're fine. What really is for is because they still have not made this illegal, and I don't know why. When somebody pulls their credit, the credit bureaus do sell their information to other people that are willing to purchase it. So if I pull a client's credit, hard pull, and they're not on the DNC or the do not call list, they will get flooded with a bunch of people that just buy credit inquiries and make phone calls all day, and their phones will not stop ringing. And it's annoying. It makes us look bad, even though we don't do anything. We legally cannot give their information out to anybody, and we really wouldn't want to, even if we could, right? Because it doesn't make any sense for us. But it annoys the shit out of them too. And it's like it becomes really bad. They'll get, like, I'm not kidding, 50 to 100 phone calls a day for like 2 weeks straight. So to kind of really prevent that as well and help them feel like they're not being just attacked because they wanted to apply for a loan. Yeah, you see, I literally have to have that call every time with the buyer. Yeah, it should be illegal, and I think, and I'm hoping that I thought that they were working on it. I haven't heard anything recently through Congress on it, but the fact that, right, people are buying credit inquiries and just calling people nonstop like that is really bad. So the soft pull is going to eliminate that, and then we'll only be pulling credit at the time of closing. She didn't want to go any further after that. Look, you see. So you hear these stories, and it happens a lot too, where clients just feel like, yo, this is too much. They're already overwhelmed at the process, to then also be bombarded with other people. Calling them and texting them all day is a lot. So the soft pull will happen in the beginning, and then we will do the hard pull towards the end. Now, this is twofold, right? It's good because the client's credit doesn't get pulled, but then it's also something to worry about, because that hard credit pull will be pulled before closing. And if they change something, if they do something to their credit, it will show up then. So it's kind of twofold, and that's a conversation that we have with both the agents and both the clients, right? If the agent doesn't feel comfortable with the soft pull because they know that the hard pull is going to have to happen at closing, then at that point we talk to the client together, right? But if it's something where the client has great credit, that they're in the 800s or in the high 700s, there's really no point of trying to do a hard pull on their credit, right? It's only if they're like at the borderline 640 to 650 where it's like, no, let's get that in now because that's going to last 4 months. because if it goes any lower, they may not qualify, things like that. Yeah, have the client sign up on the do not call registry prior to a mortgage credit check. Yeah. Yeah. So that's one. Number two, I put the link earlier. I'll put it back here. I know some people were typing. NAREB is having Black History Night, March 23rd at the Miami Open. Would love to see you guys there. It is not a real estate specific event, even though NAREB is going to be one of the organizations there, which you're going to meet, other realtors there as well. But it's just Black professionals in general, attorneys, every different type of organization that's in Miami is being invited for that specific night. So if you're looking to get business as a realtor, I always hear you guys say, why would I go to a real estate event if it's not going to bring me business? Well, this is an event that will, depending on the people that you're speaking to in that room and what they do for a living. So would love to see you guys out there. I believe it's a Saturday. Yeah, it is a Saturday. Yeah, so it's on Saturday night at 7 p.m. So hope to see you guys all there. And the other thing that I want to mention is that YRD, the Young Realtors Division, we are having a co-working a co-working space this Friday at my office, actually. Basically, all it is being able to work together in the same room. If you have any kind of pick people's brains on the ideas that they have, and different things like that. I don't know why Tiffany hasn't put it up on Instagram, but I'll talk to her. It's on the 15th. It's from 12 to 3 or 12 to 5 or something like that. We're just working. There's space in my office. You guys can come by. I'm gonna order some lunch for everybody, so we can eat, get some work done on Friday and just hang out. So that'll be getting sent out to all YRD members probably today, and it'll be posted on our YRD Miami Instagram as well. Other than that, if you guys don't have any questions or any scenarios, we're pretty much good to go. And I will definitely see you guys next Monday.
Thank you, Mike.
No problem. Thank you.
Thank you.
Thanks, Mike. Appreciate it.
Thank
No
you, Mike.
problem.
Thank
Thank
you.
Have a great week.